I know there's a
Thanks.
lot on your mind. Jay Powell basically seems to say, look, what we're doing, we're going to keep doing. I don't know. It doesn't seem to be anything real groundbreaking here, but we initially got a pop in the market.
Yeah, I think the two big stories here are everything that will continue, and he's extended out the swap lines, the dollar swap lines, to March of next year, which was about the only new information. Now, you could probably spin that as bullish because what they're doing by extending these programs, remember yesterday they announced that all of the alphabet soup of buying programs would be extended from September to December, is the longer you keep this going, the more the probability is that they become somewhat permanent in the marketplace. The other thing, if you really want to talk about the big issue that he's talking about, at least in my mind, is the coin shortage. If you've gone to a store and realized that there is a real problem with trying to get change right now because the banking system, because of the COVID shutdown, is not working properly, and the Fed is working diligently to try and fix this coin shortage, why does that matter? You know, for those that think about cryptos and digital payments, we might force everybody there a lot faster than we think if there's going to be a problem with getting the basics of change every time we spend something. We'll just go to digital payments and do away with it, and we may never go back the other way once we start that.
Might PayPal earnings this afternoon tell us a different story? I mean, aren't a lot of these digital, payments providers filling it in? I haven't touched a wallet, and I don't even carry it in my pocket anymore. I just got the phone because nobody accepts any coins or cash anyway.
That's exactly right. I mean, one of the problems we've had with the public accepting digital payments is their habit was not to do that, was to pay with currency, get change back. Well, now we're kind of, just like the problem with us doing, remote conference calls was there was never really a need to do it. And then the pandemic forced us to do it. And now we're all comfortable in this environment. Same thing, you're right, with paying for stuff, especially with the phone. If you whip out your phone, you don't have to touch anything. So it's funny, that might be the biggest story coming out of the Fed meeting is, what are you going to do about this coin shortage other than you put together a coin shortage task force, which sounds like a real resume enhancement for whoever gets picked on that one, in terms of trying to figure out what to do next. But other than that, the other story I think is what continues, and the longer the Fed continues with these programs, the more people start thinking that they're permanent programs and they're not temporary.
All right, so things are getting even weirder by the day. Now we're talking coin shortages. In the meantime, the bigger macro asset classes. Let's talk bonds for a sec, 'cause I think you've got a really interesting point at the top of your note here, Jim. With the background here being me and your conversation back in March about the highs being put in for bonds, that has held despite gold breaking out, despite the dollar breakdown, stocks, a lot of other big moves. Bonds are just stuck. And you point out in your note that says, look, maybe we shouldn't be reading too much into small moves in the bond market. Resist the urge. Tell me what you mean by that.
So the VIX of the bond market is called the MOVE index, or Merrill Option Volatility Estimate. Yesterday, it made a new all-time low. The bond market has never had less volatility than it has now. The range that we've seen in the 10-year is among one of the tightest ranges we've seen over a 1 month or 2 month period ever. The biggest buyer in the bond market is the Fed itself. The Fed has, through its quantitative easing programs, or large-scale asset purchases as they call it, bought nearly $3 trillion with a T dollars of bonds. The bond market used to be a measure, I'm going to quote the old British economist Charles Goodhart here, it used to be a measure, but the Fed has turned it into a target. And when you turn something into a target, it can't be a measure anymore. And with these very tight ranges and low volatility, I hear a lot of people saying, wow, look at the bond market. It's made a new 2 month low. Yeah, from 62 basis points to 58. That's nothing. That's a rounding error in normal times. And so don't overread, don't overread what the bond market is telling us. It's not telling us a whole lot about the state of the economy or inflation or anything else. It's trapped. In fact, we might already have de facto yield curve control that everybody keeps talking about whether or not the Fed's going to do it. They are such a big player in the market, and they have wrung volatility out of it that welcome to what yield curve control at least looks like, whether or not we formally have it.
Jim, what will it take then? Because the Fed is obviously playing a big role here by signaling the rates are not going to go anywhere for 2 years, right? I mean, that's really what's behind this control. But that's still the power of their language and the confidence the market has that they're going to be able to stand by that. As we see the gold bugs celebrate the breakout and the dollar break down, at what point do we start to wonder if the bond market will move despite what Powell is doing? Because it's just when we see right now that the economy changes has been going like this, right? 3 months ago it's the world is ending. Now it's like, a month ago it was everything's getting better. Now it's kind of like, okay, things are getting better but slower. And meanwhile, the bond market, to your point, showing no reflection of changes in the outlook over these last 4 months. But at some point, if the outlook is so profoundly different that maybe there's enough pickup in demand to justify the gold rally, and there's inflation, or anything that's not even reflation, inflation, what happens to bonds?
Well, bonds would sell off at that point. But let me just remind everybody that in 2012, Mario Draghi, the head of the ECB, famously said that the ECB will do whatever it takes in order to arrest the big rise of interest rates in Europe. And he proceeded to have to do nothing after that. It was just the threat that all he did, and that was what it took to kick off a giant bond rally in Europe in 2012. The point is, the words of a central banker are very powerful, and sometimes they don't even have to follow through on their language. But you're right, they are not everything. If we get to a point where inflation becomes understood to be here or imminently going to come back, that is not good for bonds. And the collective of the bond market would start to sell. Currently, the collective of all people that trade in the bond market are of about 9 different opinions. They're bullish, they're bearish, they think credit's going up or down, they're forward, backward, sideways, inside out. They're all over the place. So in that environment, the Fed dominates. You get inflation, and then the collective of the bond market is higher inflation is the worst thing for a fixed income asset. Sell that asset, and everybody starts doing that. They could overwhelm the Fed no matter how much they can print. Now, we don't have that right now. We have discussions about whether or not inflation might return down the road. Put me in the camp that in 21 or 22, I think we will see inflation, but not right away. And so until we get to that point, the Fed will hold the line on the bond market. It won't do much of anything. The flip side, what would it take for yields to go down is a unmistakable belief that the economy is falling apart and a gigantic risk-off trade. I don't mean a mild risk-off trade. I mean a gigantic risk-off trade where everybody wants to pile in to the safe asset. Again, we don't have that. We're not even close to that right now. So the bond market just continues to meander sideways and resist the urge to try and look at a 2 or 3 basis point move and attach some deeper meaning to it.
It's important that it sounds like, Jim, what you're still saying is that we did put in the low for yield at the worst of the crisis in March still, that we should assume that as the baseline scenario.
Yes, I still think the 39-year bull market in bonds ended on March 9th when we hit 33 basis points intraday on the 10-year yield. I know it closed that day at 56, and a lot of people are focused on that close in order to say,
it was way lower intraday, to your point.
Yeah, but, I think that was it. And it was in a spectacular, the technical analysts would tell us, blow-off fashion on massive volatility, on massive volume, and ended that 39-year bull market. Now, how long is it going to take to see a rise in yields? I think you'd be having it now if you didn't have this massive $3 trillion buyer suppressing interest rates, that they'd be naturally drifting higher, but they're suppressing them. And as I said, until you get either inflation or some belief that the economy is falling apart, it's going to stay suppressed right where it is, at least for the foreseeable future.
Jim, last time you and I spoke, you were feeling more optimistic about stocks. Maybe not optimistic is the word, but just saying, hey, with the current paradigm that we're describing with central bank action and papering over the problems, that it's hard to be short stocks. Since then, we've seen some churn where the market seems to want to dabble in some of the recovery plays. Do you want to go that far? I mean, how should an investor view this lukewarm recovery that we're going through? Because right now it seems like there's a lot of things at odds within the market, like we were talking about here at the top of the show, just opposing forces.
Yeah, exactly. I would actually turn it around. If you look at the high frequency data, mobility, restaurant bookings, gasoline demand, initial claims, and the like, the home base hourly work data, the economy seems to have flattened out in the last month or so. Coincident with the rise of infection counts, especially in the South and the West. The stock market still at 3260 right now in the S&P. It's holding in. It seems like that liquidity that the Fed is giving us, the promise it's going to stay there now at least through the end of the year, is as powerful as the collective of all the economic data, if not more powerful. And that was the argument I was trying to make in the last call, last time we met, and I will continue to make that call. We could talk about what the economy's doing. I think it's flattening out. I think that there's a problem with the recovery stalling. Well, what does that mean for the stock market? The Fed is still on. The Fed printing presses are still running. The promise is that they're still going to continue to run. The stock market will stay together until we get either unmistakable sign things are falling apart or unmistakable sign that we're going to have inflation. I think that what we've seen over the last 2 or 3 months will continue. Bond sideways, stocks grind a little bit higher. The recovery play, if you want to play the going out stocks, if you want to call those, that's going to probably be a little bit more tied to the economic activity if we were to see a real peak in the virus count over the next couple of weeks. Otherwise, the stay-at-home play, which happens to be most of the FANG stocks, that will probably be favored over everything else. But the overall index, I think, will continue its churn with an upward bias to it.
Hey, Jim, we're over time, but last point, I want to make sure I get your thoughts on the big breakout in gold. Are you on this train, or does the view of lower rates not getting to a new record and negative yielding debt, if we don't get past the 2019 highs, does gold eventually run out of steam? Where do you sit on this trade?
Gold is a small market, and there's a lot of people that can pile into it. Interest rates are falling in the rest of the world. You're right. We've got $15.5 trillion in negative debt. That is nearly a new record. 17 last year was the record. That is bullish for gold. I wouldn't be surprised if this thing starts looking like a Tesla stock before it's all said and done, or maybe gold starts looking like the silver stocks, or silver has looked over the last couple of weeks. When it goes, it can really go. And I still think it's in the early stages of going right now.